Welcome to the Deep Dive. Today we're really digging into a huge topic, one that sparks endless debate. Wealth, capital, how it's distributed, and where it might be heading.
Exactly. And our mission really is to try and cut through some of that noise.
Yeah, the constant back and forth.
Right. For too long, the discussion around inequality has felt a bit like a dialogue of the deaf, as it's been called. People talking past each other.
So what's our approach?
We're aiming for a systematic, methodical look, grounded in actual history and data. We're using extensive historical tax records, income, estates, that kind of thing, building on some really important work done with scholars like Anthony Atkinson and Emmanuel Saez.
And we're talking a long view here, aren't we? Not just the last few years.
Oh, centuries. Primarily focusing on the richer countries, the US, UK, France, Germany, Japan, trying to see if the patterns we see now, this high concentration of wealth, is it new or is it something familiar, maybe even worrying?
A predictable pattern.
Well, what the history shows is it's complicated, it's been chaotic, deeply political, not just smooth economics. There are these powerful forces pulling in opposite directions, some towards more equality, like knowledge spreading, but also these really strong forces pushing towards divergence, towards more inequality. And there's certainly no, automatic, spontaneous process in capitalism that just guarantees things stay fair and balanced.
All right, let's get into the specifics. How do we even measure the scale of capital in an economy?
A key metric we use is the capital-to-income ratio. Think of it like this. How many years of a country's total income would it take to buy up all its capital buildings, land, financial assets, machines, everything?
Okay, so what's that ratio look like now?
Today, in places like Britain and France, it's around 5 or 6 years. So national capital is worth about 500 to 600% of national income.
And how does that compare historically?
That's where it gets really interesting, especially in Europe. You see this dramatic U-shaped curve over the last couple of centuries.
That's U-shaped. Explain that.
Well, go back to before World War I, the Belle Epoque, right? Capital was absolutely king then. The ratio was incredibly high, maybe 6, even 7 years of national income.
7 years, so vastly more important relative to income than today.
Exactly. And the concentration of that wealth was just staggering.
How concentrated?
We're talking the top 10% of the population owning almost 90% of all the wealth. 90%.
Wow.
And the top 1%. They often held maybe 50, sometimes 60% of everything. It was a society built on inherited wealth, the rentier society.
Okay, so that's the peak of the U. What caused the massive drop?
Right. The collapse came between roughly 1914 and 1945, the era of the two world wars. And this is crucial. The huge reduction in inequality during that time wasn't really driven by, peaceful democratic reforms or rising prosperity for all.
No. So what was it?
It was driven by violent shocks to capital itself. It wasn't some kind of harmonious adjustment. It was chaos.
What kind of shock specifically?
Well, there was the obvious physical destruction from the wars, of course. People weren't saving much either. Then you had major expropriations. Think about foreign assets being seized or debts being wiped out, like the huge Russian bonds that French investors held before 1917, gone.
And inflation played a big role too, doesn't it? Wiping out debts.
A massive role, especially in France and Germany. Governments essentially let inflation run wild, or sometimes even encouraged it, to dissolve the real value of their public debt.
Which also destroyed private savings.
Exactly. Imagine your bonds, your savings accounts, their value just gets decimated. In France, between 1913 and 1950, the real value of assets like that was effectively divided by 100. And in Germany, it was even more extreme, contributing to huge social instability in the 1920s. Prices multiplied by over 300 times in that period. It fundamentally reshaped who owned what.
So out of this destruction, something new emerged.
Yes, a major structural change. This is when we really see the rise of what you could call a patrimonial middle class, meaning that middle chunk of the population, say the 40% below the top 10% for the first time ever, they managed to acquire a significant slice of national wealth. Before the wars, they owned very little, maybe 5 or 10%, not much more than the poorest half.
So the wars didn't necessarily help the very poorest,
Yeah.
but they hammered the very top fortunes.
Precisely. And that allowed wealth to shift downwards, relatively speaking, into that middle group. It created the foundation for the consumer societies we saw after World War II.
Okay, so the 20th century sort of blew up the old wealth structures through catastrophe. But what about the normal times? What are the underlying forces that tend to concentrate wealth when things aren't exploding?
Right. This brings us to some fundamental relationships in how capitalism seems to work, based on the historical data.
The laws of capital.
You could call them that, though they're more like observed regularities or accounting identities. The first one is simple math, really. The share of national income that goes to capital owners, profits, dividends, rent, etc. Let's call that share alpha.
Okay, alpha.
Alpha is equal to the average rate of return on capital, let's call that R, multiplied by that capital to income ratio we talked about, beta. So alpha R times beta.
Simple enough. If capital is 6 years of income, beta 6, and the return is 5%, R will 0.05, then capital share of income is 30%, alpha 0.3.
Exactly. It's just arithmetic. But the really crucial relationship, the one that seems to drive inequality over the long run, is the difference between R, that rate of return on capital, and G, the economy's overall growth rate.
Verse G, 3GR. Why is that the big deal?
Because think about what it means if R is consistently higher than G. It means that wealth that already exists, capital inherited from the past, tends to grow faster on its own than the economy as a whole is growing, and faster than income from labor is typically growing.
So existing fortunes compound quicker than people can earn new wealth through work.
Pretty much. The past starts to devour the future, as the saying goes. Your inheritance, if you have one, can generate more new wealth automatically than the entire economy is generating through new production and labor.
And does history bear this out? Was R typically bigger than G?
Oh, yes. Very clearly in the long run, outside of that mid-20th century shock period. Look at France, for example, from roughly 1820 to 1913.
A classic capitalist era.
Right. The average rate of return on capital, R, was consistently around 5% per year, but the overall economic growth rate, G, was only about 1% per year.
So a 4-point gap. Every year.
Every year. That sustained difference meant wealth piled up and became more concentrated, reinforcing that rentier society where your place was largely determined by what you inherited, not what you earned.
Okay, this is fascinating. Because it sounds like extreme inequality isn't just one thing. The data suggests there are different kinds of very unequal societies.
That's a really important point. Yes, you can get to high inequality through different routes, and the societies look quite different.
Let's contrast them. First, the old model, the Belle Epoque in Europe.
We call that the hyperpatrimonial society. Patrimonial meaning inherited wealth. Here, the hierarchy, who's on top, it's almost entirely determined by income flowing from inherited capital. The defining figure is the rentier, someone living off their investments.
You mentioned Balzac earlier, the novelist. There's a great bit in Pere Goriot that captures this perfectly, right?
Absolutely. It's almost brutally clear. The cynical character Vautrin is talking to the ambitious young student Rastignac. Vautrin basically says, look, how many top lawyers in Paris make 50,000 francs a year by the time they're 50? Very few.
A fortune back then.
A huge fortune. But then Vautrin points out, find a young woman with a dowry of 1,000,000 francs, marry her, and boom, you instantly have an income of 50,000 francs a year, assuming a 5% return and you're only 20.
Wow. So marrying an inheritance gave you instantly what decades of high-status work might barely achieve.
Exactly. The reward for past capital accumulation just completely overshadowed the potential reward for present labor, even highly skilled labor. That's the rentier logic.
Okay, now contrast that with the other model of high inequality, the one that really took off in the U.S. after about 1980.
Right. We could call this the society of supermanagers. Here, the driving force behind rising inequality isn't so much income from capital, though that's still important, but rather this explosion in very, very high incomes from labor.
Labor income, like wages.
Yes, but we're talking extreme wages and compensation packages at the very, very top. Think CEOs, top finance professionals, etc., the working rich, you might say.
How do we know this? Is it quantifiable?
Oh, definitely. Tax data makes it quite clear. If you look at the massive increase in the income share of the top 10% in the U.S. since the 1970s, most of that increase is actually explained by the gains of the top 1% and even the top 0.1%.
So it's not just, say, college graduates pulling away from high school graduates.
That gap exists, sure, the skills gap. But quantitatively, the sheer scale of the income explosion for those earning, say, over $500,000 a year, the supermanagers, is a much bigger part of the inequality story in the U.S. over the last few decades.
But hang on. If it's driven by these top earners, doesn't that make it feel more, well, meritocratic? People earning their high incomes.
That's the narrative, yes, the hyper-meritocratic idea. But the data throws up some real questions about that.
Like what?
Well, if it was purely about, say, technology demanding unique new skills, you'd expect to see the supermanager phenomenon everywhere.
Okay.
But we don't.
Where is it less pronounced?
While the top 1% income share soared in the US and also the UK and other Anglo-Saxon countries, the increase was much, much more moderate in places like France, Germany, Japan, Sweden.
So same technology, same global markets, but different outcomes for top pay.
Exactly, which strongly suggests that it's not just about skills or technology. It's also about institutions, regulations, tax policies, and perhaps crucially, social norms about what kind of compensation is considered acceptable at the very top. Culture and politics seem to play a huge role in shaping labor inequality, not just market forces.
Okay, let's bring this back to the future then. We had the rentier society, the mid-century compression, the rise of the supermanager. What's happening now? Are we heading back towards something?
This is where that walk-it dynamic becomes really central again. The argument, based on current trends and projections, is that the forces pushing towards a capital-dominated society where inherited wealth becomes paramount again are getting stronger.
Like the Belle Epoque, but maybe with different clothes? What's driving this potential resurgence?
The biggest single factor is probably the expected slowdown in economic growth, in G.
Why is Grake slowing?
Primarily demographics slowing population growth, even shrinking populations in some rich countries, and maybe slower productivity growth too. The era of rapid catch-up growth for many countries is over. Global growth, which was quite high from 1950 to maybe 2012, is projected to fall perhaps to around 1.5% or even lower in the latter part of this century.
And when G goes down?
The importance of existing capital automatically looms larger. Remember, the long-run capital-to-income ratio, beta, is basically determined by the savings rate divided by the growth rate, beta, SGOM.
Right, so if G gets smaller, even with the same savings rate as, the total stock of capital relative to income, beta, gets bigger.
Precisely. If growth slows significantly, the capital stock could swell back towards those Belle Epoque levels of 6 or 7 times national income globally by the end of the century.
And if capital becomes that dominant again, what does it mean for inheritance?
Well, the projections are pretty stark. If you assume low growth continues, then for a country like France, the annual flow of inheritance and gifts could reach back towards maybe 20–25% of national income each year.
A quarter of the economy changing hands via inheritance every year.
Potentially. And the stock of inherited wealth could climb back to making up 80 or even 90% of total private wealth by 2100.
9/10 of all wealth being inherited. That sounds exactly like the 19th century structure.
It's structurally very similar. It means the vast majority of capital owned by people in, say, 2080 or 2100 wouldn't be wealth they saved from their own work, but wealth they received from previous generations.
Now, some people might argue, okay, but we live much longer now. People inherit later in life, maybe when they're already retired. Does that change things?
It's a factor, yes. People do live longer. But a couple of things offset that. First, there's been a big increase in gifts given before death, inter vivos transfers.
Parents helping kids out earlier.
Exactly. So the average age of someone receiving a substantial gift today might be, say, 35 or 40. And even for bequests after death, the average heir might be 45 or 50.
Still young enough for that wealth to compound significantly over their own lifetimes.
Absolutely. It arrives when people are often in their peak earning and saving years themselves, allowing it to grow powerfully. And second, the idea that wealthy people spend down all their assets in old age, the standard life cycle model, doesn't really hold up for the very rich.
They don't just liquidate everything.
Not typically, no. The desire to maintain status, security, and especially to pass wealth on to the next generation, the dynastic motive, seems very strong at the top. They don't tend to massively desave. They conserve and pass on the capital.
Which just reinforces that concentration loop driven by RG dollars.
So yeah, that's the loop. Capital stays concentrated and it keeps growing faster than the economy overall.
So wrapping this all up, we've traced this huge U-curve in wealth driven by historic shocks. We've identified this core engine of inequality, the rate of return on capital usually outpacing economic growth. And now it looks like that engine might be revving up again in the 21st century because growth itself is slowing down.
That's the core dilemma, really. We do have forces for convergence knowledge, skills, education spreading globally. That's powerful and positive. But we also have this fundamental divergence mechanism, RG dollars, which constantly threatens to pull things apart, potentially taking us back towards a society where inherited wealth dominates, maybe even more than the supermanager inequality we see in the U.S. today.
And that has profound implications, doesn't it, for how we think about fairness, about society. Modern democracies are built, at least in theory, on this idea of meritocracy, right?
Exactly, on this sort of meritocratic hope. The belief that inequality, if it exists, should somehow be justified by effort, talent, contribution, common utility, as the French Declaration of the Rights of Man put it way back in 1789.
But if the defining factor becomes who your parents were, what you inherit, that challenges the whole social contract.
It absolutely does. Which leads to the final thought, really, for you, the listener. Given that extreme inequality historically tends to generate political conflict, how long can our democratic systems really tolerate this potentially massive, self-perpetuating concentration of inherited wealth? Especially if the figure of the rentier, someone living off capital returns that might feel increasingly disconnected from any current contribution, becomes dominant again.
What choices do we have?
Well, societies can shape these outcomes. Through policy, through institutions, you can choose to measure and try to transform the structure of inequality. The fundamental question for this century might be, what choices will we make to ensure that social distinctions are based more on shared principles of fairness and utility, and less on the pure accident of birth? That's the tension we're likely to live with.